Hi, this is Lisa Drwyer, and I am with Mortgage 101. And today's show is about understanding your credit, understanding your reports, and understanding all of the different items that are in your credit report. I am not here to sell you anything or tell you how great I am or rates are, with my company. I'm here to try and educate you on understanding anything related to your mortgage. I have a very special guest today with me. I have Dave Sullivan from Credit Technologies. Thanks so much for coming, Dave.
Thank you, Lisa. My pleasure.
Dave's been with the company for a long time. Tell him a little bit about your background.
Well, I've been in the credit industry for over 20 years, and I've owned my own credit company. I worked for the largest credit provider, and now I work for a company called Credit Technologies.
I mean, there are so many different levels of credit reporting. I mean, there's the inquiries, the actual creditors that report it, the mortgage, collections, bankruptcies. There's so much to a credit report. I think it's very overwhelming.
Yeah, there are many facets that make up your credit history, and actually 60 Minutes recently did a story about it, and what they said was that there were 40 million people out there with errors. Now, they weren't all material, they didn't all materially impact the score necessarily, but you should definitely always check your credit report for errors. Even if it's just an address, it is important to have, especially now with the tightening of the mortgage requirements.
Right, because our scores, your score from your credit report will dictate your rate in most cases.
Right, and many times even an address will cause a delay in the mortgage process. Even though it won't necessarily impact your credit score, it will impact the delay of getting the mortgage. And, credit is used in a lot more than just mortgages. You've got insurance, you've got homeowners insurance, looks at credit scores.
Sure, and that affects your rates. So you will pay more money if your score is lower.
Right, and employers are looking at your credit score as well. So you really have to be diligent checking your credit report at all times.
Sure. Before we get into the whole understanding your entire report, there's a couple things that pop up, like a fraud guard. Explain that a little bit to people, because they're like, there's fraud on my credit. And I say, no, it's not really that there's fraud. No one's committed fraud against you.
Right. Well, many times mortgage companies will run in the background a fraud check. And that fraud check just checks the address that you're using to what they have in their records. And if something pops up, it's not necessarily something you should be concerned about. It's just that maybe the mortgage broker should look further into it. That's all it's saying. So it's not really you have fraud. It's more like you have something that needs additional verification.
Sure, and it's a good alert for everybody.
Absolutely.
For them and for us, being the mortgage company. Now tell me a little bit about FICO score, or the score on a credit report.
Well,
What makes the score?
Well, okay, so there are three major repositories, and they gather the data: TransUnion, Equifax, and Experian.
Right.
They gather the data together, and then as you order the credit report, it is run through, in a mortgage situation, it's run through Fair Isaac, and they give you a score. So in the mortgage industry for years, actually since we started using scores about 15 years ago, we've always used a FICO score. And the FICO scoring range is 300 to 850. Well, about a few years ago, Vantage came along, and Vantage is a LLC of the three major repositories. They came together and created this Vantage score to compete with Fair Isaac. And the problem is their range is 501 to 990, so it's kind of overlapping, and we'll talk more about that in a second. But when you order your credit report, even from annualcreditreport.com, you're winding up with a Vantage score. So it's very misleading, and people become confused about
Right, and that's one of our documents of the day today, is to talk about that.
Right.
Now, I guess we can do that now, right?
Sure.
Talk about the difference between the scores. I'm going to put it here in front of you so that you can kind of show people. There you go.
Well, what I tried to show with this graph is that really there's a Vantage score out there, and actually the Vantage 2.0 score includes rental history. The FICO score does not, so that was something new that happened. But so the FICO scoring range, as you can see here, is 300 to 850, 501 to 990. So when you pull your credit report from annualcreditreport.com, you get a Vantage score, and your score could be 700, which normally from a mortgage perspective.
Right, that's awesome.
Right,
Hey,
you say,
great.
yeah.
We can get you a mortgage.
Right.
We can do this. Yeah, you got a great rate.
So then you call a mortgage broker and they pull your credit report and it comes back in 500, right?
Right, and then
So-
they come to me and think that I've done something
Right,
wrong.
then
or-
you've done something wrong. So
Sure.
there's a lot of confusion around this. I put the slide together to kind of alleviate those concerns, and it's probably the number one question that I get from my loan officer clients, that why is this score, they said it was 700, why is the score now 500?
And what
when
are
I
the
get it?
differences? What are the differences between the FICO for mortgages and the Vantage? Why is there such a big difference?
Well, Vantage created the scoring model range for them at a different level than FICO. I think that there were some legal problems with them using 300 to 850, obviously, so they kind of came up with a different range. The Vantage score primarily is used for insurance. So when you get an insurance policy, they use a Vantage score, and they know that the range is different, so they can appropriately address their liability.
Sure, and the average person, the biggest percentage is where?
Well, the biggest percentage is 29%, 681 on the FICO score to 780, 800 to 899 on the Vantage score, which is interesting. You wouldn't think it'd be that high because
Right.
a lot of the people who are not applying for mortgages, though, have good scores because they don't need the credit. You know,
I was going to say my average is probably the 660.
yeah, and that's a tough range because they're right at kind of the, they could very easily fall down. And
Right.
We'll
The
talk
minimum
about,
for us to, we have some programs that we can go as low as 580, but there's
Right.
pretty strict guidelines, and there are lenders out there. Most of the conventional banks want you to about 700, 680, 700. Mortgage One, we can do FHA and conventional and rural development, and we look for about a 640.
Okay.
So that's where we start at our.
in 660, it's very easily to slip down below there, especially during the mortgage process.
Sure.
Yeah,
Sure,
there are some
absolutely.
things that we can talk about there.
Well, we have a lot of great things to touch on today, and I think that the most important aspect of today's show for me, Dave, is just understanding your report, understanding the different, I don't know, I guess.
Categories?
Yeah, how it would come into play, how the score actually ends up being a 650. Do I have, people ask all the time, should I close my accounts?
Sure.
That's a big question.
Right.
Maybe we could address that.
Well,
Just-
there's a lot of different things, but I'll tell you the number one thing from a mortgage history standpoint is the length of credit history. You always want to have a long credit history. So when you're thinking about closing accounts, you don't want to necessarily close the oldest accounts you have. You want to close newer accounts. And actually, I would tell you, prior to a mortgage, you shouldn't close any accounts.
Right, yeah. People come to me and I see they have $30,000 available.
Right.
It's like, okay, Lisa, I have all this money, all this credit available. Do I close them all? Well, then I'm looking and they only have maybe one that they're using and all the rest are old. They haven't been, they're still reporting monthly, but they haven't had any activity on them. So I
Right.
tell them, do not do anything until I either talk to you
Right.
or find out for sure where their score is going to be. We'll be right back after this, and we're going to get into inquiries on your mortgage, on your credit report, and how that affects your score. And we're going to talk about balances on your credit card. So we'll be right back. Thanks for watching.
About the American Legion's commitment of service to America.
Hello and welcome back. I'm here with Dave Sullivan from Credit Technologies, and we are talking about your credit report and how important it is to understand all the different facets of the credit report. We spoke about the score, what makes the score, the difference between the FICO and the Vantage, yep. And now we're going to talk about inquiries a little bit. How do inquiries affect your score?
Well, there's a lot of confusion about inquiries and how they impact the score because FICO has changed the way they've handled them over the years a number of times. So at first they said that all inquiries will count as one inquiry and then impact the score. And then they said, well, if somebody's going to 5 different auto dealers, maybe they should not have 5 different auto inquiries because they're not going to get 5 different cars. And they said, well, what we'll do is we'll give them a 45-day window. Actually a 14-day window to shop that. And then they said, well, we'll go to 30 days. And then they said, well, all right, we'll go to 45 days. So now we're at a 45-day shopping window, meaning like inquiries will be grouped together and counted as one.
Oh, that's awesome. And
Yeah.
same, does that go with mortgages as well?
Mortgages and student loans are all grouped together as one, provided they're within that 45-day window.
And then tell me a little bit, the biggest question I have is, I already had somebody pull my credit. How much does it affect my score if you pull it?
Well, what FICO did in addition to that is they gave you a 30-day window with no impact. So right now, there's a 30-day no impact window. So if they pulled, another mortgage broker had pulled the score, there's a 30-day window where it doesn't have any impact at all.
Good.
So how much does it impact the score? That was your other question.
Yeah.
That depends on the file itself. Because the FICO scoring model is dynamic, you know, one inquiry on one report is going to have a different value than one inquiry on a different report. So anywhere from 0 to about 15 points is all you're going to impact.
Well, that's what I was, you know, they had said to me, my clients, they say, well, if I went, you know, let's say they're looking for a car at the same time.
Yeah.
And that effect, I mean, to me, it seems like the car industry really, I don't know what happens, but as soon as someone says they're looking for a car, it becomes an explosion of inquiries
Yeah.
on their report.
Right.
And then they notice the difference. They do. And then they come to me and say, well, my score was, you know, a 700 or a 680, and now it's a 620. Or, you know, I wondered how many inquiries, you know, is there a ratio? Like 5 inquiries is 1 point, or does it work like, how
No, it
does that
doesn't work like that. It's dynamic. It depends on the other information in the credit report. So if they're around 600, inquiries are going to have a bigger impact. But it's not going to go from 680 to 620. I mean, you might come down 5 or 6 points, but there are other reasons more than likely that the score came down.
Okay, well, that's
I don't
good
know
to
what it is about people who want to apply for a house. They suddenly have to go buy a bunch of other things.
Believe me, I want to just...
Yeah, right. So if you're going to apply for a mortgage, one thing I'd tell you is don't shop for anything else. Don't you know, don't buy anything. Don't go to Art Van or
Right.
any store really.
That's what I tell them. Wait
yeah.
until we close, then you can shop your heart out.
Right.
And don't do it the day before we close, because we re-pull your credit.
Yes, exactly.
You know, we do.
Yes.
We pull it right before we get our closing docs out, and we do that to make sure you guys are so on top. The credit agencies are just all over my borrowers.
Yeah. Well,
if we do anything, if they go in, you know, Art Van, if they go and
Right.
look at a car, if they do, I mean, then I have to get letters of explanation. I'll ask you for LOXs for everything, that you didn't buy anything in Art Van, that you didn't go buy a car, or, you know, and we're going to be talking, I have an insurance agent coming in, and we're going to talk about the insurance scores, how that affects it. So
Sure.
we're really going to have credit is so important. I know, and I believe in Dave Ramsey. I teach Dave Ramsey, and I am debt-free as well. But, I mean, credit is important.
Well,
It
it's like,
is.
yeah,
It's-
I mean, it's like insurance. You know, hopefully you'll never need your credit, but if you need it, it's nice to have it.
Sure, absolutely. Yeah, right. Insurance, it's not an option, right?
Right. I mean, it's nice to be able to go anywhere and get the best rate, and that's what.
And how long, okay, inquiries. So there's different types, right? You have the car and
Well,
what
I mean,
else?
there are industry types, but then there's either a hard or soft inquiry.
Right.
And those hard inquiries are the ones that we were just talking about. Now, a soft inquiry won't impact your score at all. And those are the ones where the consumer actually inquires themselves to find out how their credit report is. So if they go to annualcreditreport.com, that inquiry does not impact the score at all.
Right, okay, great. And how long do they stay normally?
Inquiries will stay on the credit report for 2 years. But like I said, they're grouped together as one.
Right, for 45 days. So if
in that
someone's-
45-day window, right.
Perfect.
And we'll have an example of that here in a second.
Yeah, I do.
But-
I do want to talk about that a little bit.
But they will stay in your credit report for 2 years and then fall off. And the impact of the inquiry really drops off after, I would say, 8 months. It starts to really drop down. So we talked about how FICO's changed how they handle the inquiries. There's a no impact window for 30 days, and then they're grouped together within the 45-day window. So I have a quick little example here on this slide of a mortgage inquiry, an auto inquiry, another auto inquiry, and then the third auto inquiry, which is much like your applicants, right?
Right.
Right. So if they do all that in January, of course it'll have no impact for 30 days, but come February, on the 1st, that first mortgage inquiry will impact their credit score. And then on the 2nd, they'll have one auto and one mortgage. But on the 4th, 5th, and 6th, those other inquiries will start to impact the credit report, but because they're grouped together, they'll still have one auto, one mortgage.
Well, that's a lot, and I want to reiterate this, that Dave and I speak the same language most
Right.
of the time.
Yeah, right, right.
Most of the time, I'm calling and say, "Can't you fix this? Can't we do this? What can we do?" But in the sense of what we do, we're here to help people. We really are. That's where our heart is at, and that's what we believe in, and that's why we love our job, because we do want to help
Right.
the community and the public. I know we speak sometimes today in terms that maybe you don't understand or you're not used to hearing. All of the information that we talk about today is available for your viewing. Either you can go to Mortgage, it's mtg101.net. You can go to my Facebook page,
Yep.
or you can call at 248-627-7283, and we can give you a script of everything we discussed today. We'll be right back. Welcome back to Mortgage 101. I'm Lisa Drwyer. This is Dave Sullivan from Credit Technologies, and we're talking about your credit score, how your score impacts all different avenues of your life, your insurance, your mortgage, your car rates, and we talked about inquiries, and I'm really excited to have you on the show today. It's so informative and educational for everybody, and that's what I want to do. That's the purpose of this show for me, is to educate you on what's supposed to be your best asset, and that is your home.
Yeah, and also employers are looking at credit reports.
Oh,
as
right,
well, so.
right. Your job, your income may be infected, not only what you spend.
Absolutely.
Great. Now, our last segment here, we kind of want to talk about, and I'm going to just reiterate that everything is available on our Facebook page, on my website, mtg101.net, and we can hand you papers that explain this information that we're talking about today to you by just calling or emailing us and requesting that.
And actually, we just set up the Facebook page.
Yes,
the
he is
101.
awesome. He's amazing.
So actually, you can actually log on to the Facebook page and watch the previous shows. And you can also start the mortgage process if you like and find out your real 3 FICO scores by clicking on the mortgage pre-flight link. There's a quick little questionnaire, you fill it out, and then you're delivered back a mortgage pre-flight report.
Yes, and it has your scores,
And it has
which is the most, that's the most valuable thing to start off with.
Yeah.
Where do I stand with my credit?
Exactly, and those are the real 3 FICO scores that you're going to use to close the loan. That's
Yes.
actually the same report that you're going to use, so
Yes,
it's a great way to start.
The best scores.
Yeah, the real
The real
mortgage,
deal,
yeah,
right.
scores. Good.
All right, so we're going to talk about the balance on your credit card and how that affects your score and
Right.
Ultimately your interest too, right? I mean,
Right. Well, I think the advice that you receive needs to be very tailored to your situation. If you're about to start a mortgage process, you have to be very careful about how you handle your credit. We talked about that earlier. There's a very few things that you can do safely, and one of the things that you can do that will almost always increase your score is paying down the balances on your revolving credit, meaning credit card, right?
Right.
So there's a lot of confusion on what you should pay your balances down to, and the best thing to pay your balances down to is really 5 to 9%.
People ask me if I'm 60% or 50. I mean, we can do the model, and I'm not sure what the technical term is. When we pull your credit, it shows if I can add
Yes.
points to the
Right.
credit. We can click on that. We do it per bureau, and it will ask me, do I want to raise it so many points, or do I have so much money?
Right.
And it will tell me usually to pay the bills down.
Well, Lisa,
And that's a huge jump.
yeah,
That really is.
Lisa has access to our software, which allows her to do a what-if scenario, or it will just give you the amount of points that you can receive if you pay things down. Now, many people will say 30%, 50%. There's a problem with that advice, though, and it's a pet peeve of mine. Actually, if you were at 50% and you go to 49%, you're going to get a much better improvement in your score with that 1%. But if you go to 48, 47, 45, you get nothing until you get back down to 39%.
And this happens. People go and pay something off, and they come back, Lisa, I'm so excited.
Right.
I had a credit card. There was a $300 balance,
And I paid
it off. And I go, oh, crap.
Yeah.
Hang on. I have to call Dave.
Right. Well,
And then Dave says, oh, no, you've now ruined it.
Right. That is a situation because the FICO scoring model looks at that account like you're not using it anymore because it's a zero balance. So you want to be in between 5 and 9%. I actually did this with my own credit report. I paid it actually down, so I had a credit balance. because I wanted to get a very high score just to see.
Sure.
And my score went down because I paid that report or that account to below 0. So I thought it was 0 and my score went down. I went back up in between 5 and 9% and it jumped back up to where it was.
So do you think that that is the way that the Bureau averages or scores you based on your ability to keep a low balance without maybe losing control and going, you know, keeping, first of all, your payments on time is very important.
Very important, yeah.
Obviously, right? That's probably
Yeah,
the
that's the number
most,
one thing, yeah.
the most important, and we've kind of failed to,
Well, I mean,
you know,
again,
that's the very,
well, we're at a different level. You know, we're kind of already assuming that you pay everything on time. You don't want any collections.
I don't ever assume that, Dave.
All right. Well, once you've done those basic things,
Right.
the things that we're talking about are really the advanced things, the
Right.
things that you want to do right
The first thing is, of
before.
course, making your payments on time.
Yeah.
Secondly would be keeping your balances to,
Low.
yep, and then
Right.
inquiries, right? Are those like the three main?
Right. I mean, paying down balances is the only thing you can do right before you apply for a loan that's not going to hurt you. So again, if you're at 50 and you can get to 49, you're better. If you're at 30, get to 29, you're better. And many times this is less than $100.
Right. Yeah, a lot of times my credit score fixes, I guess is what, if I could call it that, where I can get the jump or just a little edge on
Yeah.
my score, are just very, couple $100.
And that's
it
what-
may be a little bit here and a little bit there.
Right. And that's what's nice about that pre-flight report we just talked about.
Yes, and that's a great opportunity.
Yeah, on the pre-flight report, not only is it a summary of your credit, it also gives you potential score improvement, and that is all reflected in paying down balances.
Right, and I think that if people understand just doing the couple little things, it'll help their score so much.
Right. I mean, I've seen credit reports before where there's never been a late date, and many times it will be in the low 600s, and it's for no other reason than the fact that they're over the high credit.
Yeah, high balances on their cards.
I mean, these
For
are
sure.
doctors too, and they still have low credit scores because they're over the high limit. Even if they're paying it off every month, if they're jumping up over the high limit at the reporting date, which is the key date.
Right. So the best limit, the best credit limit, I mean, you want to be around what, 40 to 50%?
No.
To maintain, where would you?
Well, here's the thing, and it's all about timing. So as you come closer to applying for a mortgage, you want to peak your credit score. And the way to peak your credit score is to get your balances down to 5 to 9%.
So you need to be there for this at maximum
If you
score.
want to maximize your score. If you're okay, if you're in the high 700s and it doesn't matter, then you're fine with whatever you're doing.
Right.
But I would tell you, if you're in the high 700s, more than likely, you're keeping your balances low anyway.
Right. Or you have a lot with a lot of open but not used or low balances. Yeah, I mean, that's what I see. You
Yeah,
know,
and you have to be really careful about that reporting date. I know I kind of briefly talked about it, but the reporting date is the date that the creditor sends the information to the repository. And if you don't have your balance low at that reporting
Right.
date, not the due date,
that's important because
Yeah.
people will say, I'll go pay my Capital One card off. When can you repull it? Well, I'm only allowed to repull it every 30 days.
Right.
Now, we can do certain things with you,
Right.
rapid rescore or things like that, but
we
yeah,
can
the
do it-
dates are important.
the dates are very important. And if you're paying your balance on the due date, not the reporting date, you run into the problem of having your balances higher than they necessarily would be.
Well, let's take a minute just to talk about the ratios. So,
Right. So I've got this confusing graph here for you, and I just wanted to show you, as you come down in your utilization ratio, if you go just to the next 9%, you'll be far better off than if you just pay it down to 70. So if you pay it down to 70, if you just go to 69, you're going to be much better. And if you go to 59, 49, 39, 29, 19, 9%, that's the best. That's where you want to be.
perfect. And we understand that this is confusing. We know that this is not something that you're used to hearing or seeing.
Sure.
But that's what we're here for.
Right.
We're here to help you out. We're here to help you understand. We want you to contact us. And we can give you the information that you need specific to your score. We'll pull your credit. You can pull your credit yourself again, right? They
Yep.
can go to pre-flight.
Yep, they can go to your Facebook page and click on the pre-flight
Just
button.
it's mortgage. The Facebook page.
Is Mortgage 1, I think, and then 01.
Yeah, Mortgage 101.
out, yeah.
It's spelled out. And you can go to our website also. It will show you and link you to the Facebook. And that is mtg101.net. And you can call too at 248-627-7283. And we'd be happy to give you everything we spoke about today in written form so you can review it yourself. It will have Dave's information, my information. And again, we're here to try and help you save money with all the processes that surround your mortgage. So thanks so much for watching today. Dave, thanks again for coming. It was such a pleasure having you. And God bless, and we'll see you soon.